Krystal, what are you taking a look at?
Well, guys, we recently warned you about a key recession warning light that was flashing bright red. The yield curve for Treasury bonds has gotten wacky before every single recession since 1970, flipping so that long-term yields are lower than short-term yields. That's the reverse of the normal relationship. That basically happens when investors get very, very concerned about the short term. Well, right now we are seeing the inversion of that telltale indicator. There are some reasons to think that this time could be different. In particular, the Fed has been messing around in the bond market a whole lot, so the market may not contain as much information as it usually does. But this week, we're getting a host of new warning signs and indicators that add to the dire picture. In fact, Deutsche Bank just became the first major bank to predict that our economy is headed towards recession. Here's a little bit of what they are saying. They believe we'll be in a recession by next year, that stocks will likely drop by 20% by the summer of next year, and that unemployment will rise to nearly 5% by 2024. But that's not all. JP Morgan CEO Jamie Dimon is warning investors of, quote, unprecedented risks and the need to prepare for dramatic upheavals. Now, he does not outright predict a recession in this letter to investors, but it's hardly a rosy portrait that he is painting here. And if all of that doesn't have you nervous enough, famed investor Carl Icahn says we could be heading to a recession or even worse.
Yeah, look, I think there very well could be a recession. Or even worse. I really think the one thing that I do have experience in, and I will tell you sadly, that our companies, when we sit on a lot of boards. I don't, but I have delegates on those boards. And some are good, some are fine, but when you get to understand what these boards do, the system is needing fixing. They're really odd. There's no accountability in corporate America. You have some very fine companies, there's some very fine CEOs, but far too many that are not up to the task that I think is going to be necessitated. So I have that experience, I guess. And then I tell you this, I have kept, and I think we would have done a lot better, but I have kept everything hedged for the last few years. And I think now that we do have it, we have a strong hedge on against the long positions that we try to be activists in and get that edge. So that's the way I look at it. But I am negative, as you can hear. Short term, I don't even predict, I guess.
Now, there are a number of reasons that a recession seems increasingly likely. Supply chain shocks, expensive oil, war in Ukraine, and overall inflation, which is not only a problem in and of itself, but critically is leading the Federal Reserve to move in a big way. And on that front, we have some massive news indicating that they might well be ready to slam the brakes on the economy. First, let me give you a little bit of backstory and context here. So the Fed has been indicating for a while they're going to hike interest rates. And in fact, they just did so for the first time last month. A quarter rate hike that was more or less taken in stride. But now they look prepared to take a much more aggressive course than some were anticipating. And the more aggressive the action at the Fed, the more likely it tips the economy into recession as they try to squeeze out inflation. That's exactly what happened in the 70s. Fed Chair Paul Volcker is celebrated for dramatically hiking interest rates and successfully curbing inflation. But at the time, he was hated. His decisions caused a brutal recession with unemployment spiking over 10%. His actions were actually so painful and controversial, they led to the largest protests in the history of the Federal Reserve as indebted farmers drove their tractors to the Federal Reserve Board building right here in Washington. This time around, it's not just interest rates that the Fed has as a weapon in their anti-inflation arsenal. During COVID, interest rates alone were not going to be enough to keep markets from tanking and the wheels from completely coming off the global financial system. The situation was so dire that even one of the safest and most liquid markets in the world, the one for U.S. Treasury bonds, basically seized up and all but stopped functioning. This event completely and understandably freaked out everyone who was paying attention. So the Fed leapt into action and intervened in the market in truly extraordinary ways. They bought trillions of dollars of assets to backstop both the stock and the bond markets. Now, we can save the debate for another day, an important one, by the way, over whether they could have taken more creative action to directly help regular Americans rather than just shooting trillions of dollars at Wall Street. But suffice it to say, while this action may have been necessary, it created vast amounts of inequality, funneling wealth to the top while regular people comparatively got peanuts. Regular folks, of course, had to depend on a dysfunctional Congress, while the rich could rest easy with the quick-acting Fed. As Christopher Leonard details in his book, Lords of Easy Money, this Fed policy of scooping up massive amounts of assets overwhelmingly benefits the very top as those assets are being purchased. But it creates massive risk for the entire public when they then try to unload these trillions of dollars in assets from the Fed balance sheet. And because the Fed went so far and so fast, acquiring the equivalent of a third of our entire GDP in just a couple years' time frame, what happens with those assets on the Fed balance sheet, that is the real story to watch with regard to Fed policy. So with all of that in mind, we've now got bombshell new details about what the Fed is actually planning to do with those assets. Fed Governor Lael Brainard, she said on Tuesday that it is of paramount importance to get inflation down, going on to say the Fed, quote, will continue tightening monetary policy methodically through a series of interest rate increases and by starting to reduce the balance sheet at a rapid pace as soon as our May meeting. Now, I know these comments sound a little bit innocuous, but they landed like a bomb. Brainard is one of the most dovish members of the Fed, typically advocating for looser policy and lower rates. So if she is saying they're going to go at a rapid pace, it really means something. So now you're looking at interest rates likely to go up much more quickly, and at the same time, the Fed offloading assets at what is being described as a rapid pace. That's basically the equivalent of hiking interest rates even higher and more quickly. Now, the Fed believes that they can find the magic formula here, doing enough to control inflation, but not enough to sink the economy, a so-called soft landing. That is extremely difficult to pull off because the Fed only has blunt tools to use, and because the impact of their actions are not immediate, it's very easy to overshoot the mark and trigger a cataclysm for working class Americans. Add to all of this the chaotic landscape of war, climate crisis, food shortages, supply chain messes, and you should not be surprised that people are starting to ask the question of when, not if, we're headed to recession. Now listen, there are two last things I want to say on all of this, some takeaways, some things to think about. First of all, a major reason why the situation is so dicey and why the Fed has become so central to the entire economic system is because Congress has devolved into a body more concerned with culture war signaling and political theater than with actual responsive legislating. Some of the problems we're dealing with, supply chain issues, things like industry consolidation that are leading to price gouging, those should really be dealt with through congressional action instead of by hoping that the Fed can magically fix everything. The other thing I'll say about all of this is these strike waves and union drives that we're covering here, they have to move quick. Because part of why workers feel emboldened and are willing to get cheeky with their managers and corporate bosses right now is because there's a lot of jobs. They might be crappy jobs, but there are a lot of jobs. That's leading workers to do what Chris Smalls is urging, having the courage to organize at their current job instead of quit. After all, they try to organize. The worst that can happen is they get fired from their crappy job and they go get a different crappy job. In the best case scenario, they actually turn their crappy job into something that is truly worthwhile and sustaining. If we head into a recession with high unemployment, bosses are going to feel bolder and workers are going to have a whole lot less leverage. So that's just one example of how much is at stake with these Fed decisions. Worker power, jobs, and actual human beings' lives, all of that hangs in the balance. And Sagar, after I wrote this monologue, we received notes from the last Fed. Cable news is ripping us apart, dividing the country, making it impossible to function as a society, and making it impossible to know just what is true and what is false. But the good news is they are failing and they know it.
That is why we're building something new, a new mainstream, a healthier one, something more trustworthy, something that we are going to need in one of the most pivotal times in American history. We are building up here for the midterms, for the upcoming presidential election, but we need your help. So if you can help us out by becoming a premium member today at breakingpoints.com, we're trying to change America for the better and the entire world.
So what are you waiting for, guys? Go to breakingpoints.com and sign up and help us build a new mainstream.